Your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey crew, welcome back to Chat with Traders podcast. Like always, I appreciate your company. Now, as a few of you have reminded me, it has been quite some time since I've sat down to speak with a crypto trader. I know it is long overdue, but that changes right now. My guest on this episode is Matthew Dibb. Matt is the founder and chief investment officer of Astronaut Capital, a cryptocurrency and digital asset fund attracting its first investors in 2017. And prior to being consumed by crypto, Matt was a traditional finance guy, having held down roles as a futures and FX trader for banks and institutions going back to the mid-2000s, while also doing a stint in VC too. We had a great chat, and it started with a couple tales from when ICOs were all the rage in 2016 and 17, and the greatest differentiators between traditional markets and crypto markets and what it means for active traders. Then we branched into all sorts of things: crypto hedge funds, generating alpha, trend trading, thematic asset allocation, analyzing capital flows, trading pairs and options strategies, crypto-specific risk management, and more. Then, last thing, our chat ends with Matt sharing a few words for crypto newcomers. In case you're wondering, this episode was recorded 25th of August 2021. Now, coming to you from Singapore, here is my guest, Matthew Dibb. And I notice Bitcoin's back to 50 grand. How do you feel about that?
Feeling good. I'm bullish. I've been bullish for the whole month and part of last month. It's a rally that's been like spot led. So there's not a lot of derivatives or leverage involved, which is should be seen as a good thing, but we're struggling here a little bit. There's a lot of focus on all the altcoins. So it's sort of hard to grade whether if this is going to continue at the same speed or if we're just going to chop around here right now. But for all intents, we're long. So
what do you mean by it's been a spot-led rally?
So from the derivatives data that we're seeing, both in options and in swaps or futures, there's not a lot of retail that are out there punting leverage on this right now. So it means that the majority of participants are coming in and buying actual Bitcoins, physical Bitcoins, which you could say is then not really retail driven. It's more either basically old school whale holder driven or it's institutional driven, which is a good thing. But it's also a reason why we haven't seen any blow off top from 50, why it's not just smashing through it.
So how come you're wary about this rally if, that's typically a good thing?
I'm not necessarily. It's just that retail hasn't come in yet to anywhere near the same level as what it previously has. And usually retail would be in now. It's just I think retail is a little bit distracted right now with all of the other altcoins and NFTs in particular. That's flying around selling, JPEGs for millions of dollars. So it's Bitcoin it's sitting in the background of the whole scheme of things in the crypto ecosystem right now. But it won't stay like that for long.
Yeah. Well, anyway, Matt, take me back a few years. I think it was maybe 2016. Why does someone from traditional markets, Forex and commodities, if I'm not mistaken, want to jump across to crypto markets?
I mean, it's a good question. At the time, it was a little bit of a surprise for me. So in 2016, I was working in actually in venture capital for a brief stint for like almost 2 years. And prior to that, it was all commodities and FX. But I did this short stint to sort of get exposure to the tech sector. Interestingly enough, there was this deal that someone pitched us. It was for this like early stage startup, and they were doing like some identity verification type of like technology, and they wanted to raise like 500K. Anyway, for one reason or another, we ended up passing on the deal, and we're like, okay, we're not going to do this. And I must have been added to their email list or something, because like I kept getting like email updates from these guys. And like 6 months later, I get this email saying that they raised $20 million. And I'm like, how the hell did these guys raise $20 million? Like they went to every VC that we know and nobody funded them. So like what happened all of a sudden? And we found out that they ended up doing an ICO. And I'm like, what is an ICO? Like how does this much capital come flooding into a company that basically had nothing? And so I started looking into what an ICO was back then. Yeah, I saw that like the way that this fundraising spurred basically out of nothing into creating these crypto coins. And for me, it was sort of eye-opening. And that's when I took a stab into this market. I said, well, let's start looking at like what's actually happening within this ecosystem, because obviously if there's a lot of demand in terms of like funding new projects and stuff, then it's something we need to keep an eye on. So I went on, the first part of it, I guess, is where I went on to actually start a research firm within cryptocurrency and blockchain. And that was sort of centered around like looking at these new projects that were raising funds for ICOs and trying to grade them to like the best extent possible. And that, I guess, is sort of where we started within the crypto ecosystem, was more so from like a research and analytical point of view. But yeah, to answer your question, it was this like realization that all of a sudden this new method of funding, raising capital, and also just like deployment of projects into a vibrant ecosystem all of a sudden came about.
So when you started researching this more, in those early days, were you like a believer in crypto as a technology, like with hopes that it was something that would really catch on and you could see a future for it, it would become legitimized, etc.? Or were you more looking at crypto as like purely from an opportunistic standpoint?
Yeah, truth be told, I wasn't sure at that point, because back in the trading days way before then, when I was trading more traditional markets, I was buying some Bitcoin like here and there. And at the time, the guys on the desk are like, what the hell are you doing? Like, focus on BHP earnings that are coming out or something like that. And it was something that I couldn't really spend any time on and immerse myself into. From there, like once I picked it up again, I sort of saw what people were, I guess, trying to do. And of course, I mean, there was this part of me where I'm like, well, from an opportunistic and a commercial point of view, this is obviously where the money is. Whether it be from trading or investment, or whether it's bolt-on services like research or whatever it might be, there's obviously a lot of benefit in there for me. But the way in which people, I guess, are trying to innovate on this thing called blockchain is actually pretty interesting. And I guess that led us to take a little bit more of an objective approach to the market and start needing to like categorize things differently. Because I mean, you got to remember, like 2016 and 2017, there was a lot of shit hitting the markets, like scams, just full-blown scams. And trying to filter through them as an investor or an analyst was just difficult. And through our times, like we would go through at one point maybe 30 or 40 projects per week, looking at these things and trying to tear them apart. And 80 to 90% of them were just trash. And I guess when you go through that cycle for long enough, you start losing a bit of hope in sort of some of these projects that were coming in, and a lot of the other opportunistic sort of players that will come in. Because when you've got a fundraising environment like that, of course you're going to have guys come in, try to make as much money as they can and just leave. And we would see that day to day. So that was always something, of course, that would come across. But at the same time, there were always these sort of pockets of innovation that every now and then would say, oh, wow, like this is pretty cool. And I guess over the years, that has more and more come to light, I would say, since probably 2020 or late 2019, where we've actually seen real application of like some of these protocols and these applications, DeFi applications in particular, that may actually change the world and the way that people actually deal with money and finances.
As you pointed out, there were a lot of scams floating around 2016, 2017. Obviously, there's still many of those today. Do you think it's kind of at the same level?
I'll tell you a story. Like it's a bit of a funny one, actually. There was this in early 2018. This was sort of like the peak of it, when I really remembered like how bad things got. I was in New York and I don't go to New York often, but there was like a conference on, and one of my friends invited me to this party, which was at like some rooftop bar. So I was like, okay, let's go. It was some crypto sort of party. I'm not sure what it was for, but I was just like, let's do it. So we get there, and these guys had booked out of this like huge hotel, like 4 full floors. Like this party was huge. And we go up the elevators, we get out on the rooftop, and there's like, it's just full of these like Russian models. We've got like Dom Perignon and like, what do you call it? Flamethrower guys and all this sort of stuff. Like it was just nuts. Like it was like a circus. All these people there. And I'm like, what is this? What is this thing? Like, who owns this party? I want to meet the guy. And he's like, oh, it's some like blockchain ICO or something. I'm like, okay, let's like go chat to a few of the guys that are part of the team. Anyway, I go up to these guys. I'm like, so what's this project that you guys raise money for? And he's like, oh, it's a blockchain protocol for drones. And I'm like, what, for drones, like the things that fly? And he's like, yeah, for drones. And I'm like, okay, I'm not sure how that would work, but how much did you guys raise? And he's like, $350 million. I'm like, $350 million. It was like that moment from, I'm not sure if you've seen The Big Short, where they go and see all like the houses and they're all empty, and they're okay, sell everything, like short it all, It was that moment that I had, and I was like, wow, like I can't believe this is happening. $350 million for a project that nobody has ever heard of, which is like a useless protocol. And obviously the company isn't around now, but that was sort of that moment where I was like, okay, there's something sort of wrong with the way this industry is going. Now, to go back to your question, have we seen like to that extent like happen again in like the last year or two? I wouldn't say so. There has been like very opportunistic types of I guess projects that have started up, like these different dog coins. There's scams and stuff that might be a few $1 million, etc. But to the same extent from what we were seeing during like the ICO period, because back then, I guess it was more like traditional guys also coming in that would come up with blockchain for XYZ. And no one, back then, they didn't even know what blockchain was, most of these guys raising money. We aren't seeing that now. I would say we're seeing it a little bit more differently, and people aren't necessarily raising capital at like in the same fashion that it was back then either. So I would say that the market overall has gotten a lot healthier for sure.
If anyone wants to look up this drone token project, do you recall what that was called?
Dude, I've got no idea. I was just, I will try to find out, and I'll let you know, though. You can put it on the list later.
Okay, that would be interesting. As someone who came from a background in traditional markets and you jumped across to crypto, what things hit you initially as some of the differences or similarities between the two markets?
I think the biggest, and I'm going to talk a little bit more from a trading point of view here, because nowadays, I mean, to add, nowadays our focus is more so in liquid trading rather than venture capital investment. And I think, to that point, after the story that I just told you, we realized that, which was back early Q1 2018, we sort of realized that we need to have a lot more active approach. And so that's when I guess we got back on the tools and started trading rather than investing into like more liquid assets. So I would say the differences between TradFi, as they call it, and more of the crypto ecosystem from a trading point of view would be subtleties in some respects. But one thing that surprised me the most was the way in which the flows trade of capital. So let's say if you're trading traditional markets, it might be like FX or whatever, you could, every day you would see like massive volume come in, let's say during the US session, that's what you would expect, or a certain part of the day where like Europe would open. And so all of a sudden you'd start seeing like bid in like the euro or whatever it might be. In crypto, what we've found is that like those like flows of capital and volume and allocation into the markets end up changing time zones like a lot. So for a while, it might be China or like Asia Pacific time zone that is completely moving the market on a day-to-day basis. And then it ends up being the US, and then it ends up being Europe. And these change periodically, which is weird because it's something for us that we would like in traditional markets, you come to expect that a certain geography would have all of the push for a particular market. But for crypto, it seems to be really weird because it changes all the time and without notice. The other thing is that really shocked me, and you get this when you get very large sort of drawdowns. As we know in cryptocurrencies, there can be times where we see like a 30% drop overnight. Having no circuit breakers or like no pausing of the market really sucks. So, you go through like a 35% drawdown in the matter of hours. There's no one turning off the exchange. It just keeps going down. And when that happens in crypto, obviously when leverage is so built up and large positions get liquidated, it's just this waterfall effect that keeps hitting every other position and every other exchange. And then one exchange gets hit and all of their positions are liquidated. And then that has, I guess, some cross effect to other exchanges. So that, I guess, is one aspect where you're sort of waiting for it to stop at times, and it just doesn't. And you see this just hemorrhaging of the market across every single asset class. I guess the other thing is realizing that black swan events, those like 30%, 40% sort of drawdowns happen a lot more than you think within crypto. And they can happen like instantly, like even for a couple of minutes across major assets, or they can happen across the whole market. I had a situation for myself actually trading PA, personal account, in 2019, which was like quite a boring time to trade for most of it. I mean, 2018, 2019 were like, there wasn't a lot happening. But I had built up this position in Ethereum for some time. And it was doing really well. Like it was a leveraged position on BitMEX. I'm not sure if you ever use it, but it's like it's the exchange everyone goes to for a lot of leverage, right?
Mm-hmm.
So we were trading on this, and the unrealized profit of it was great. Thought there was definitely nothing to worry about. Liquidation level for this account was like miles away, like 60% of the market away. Anyway, this one morning, there was essentially a flash crash. And when a flash crash happens in crypto, like it can just go down, 30, 40, 50% in no time. This happened over a period of 30 seconds. I was actually in front of the computer watching it at that time. And before I knew it, basically the whole account was liquidated, just gone. And the worst part of it, which would be totally fine if the market kept going down, but the market went straight back up to where it was like 2 seconds later. So these sorts of things, these black swan events, let's call them, or these like meltdowns by specific assets happen quite a bit. And that's not to like scare anybody away from, because there's obviously things that you can do to hedge against that, or just having a stop loss in or whatever it might be. But it's these irregularities that really can hurt a trader without them, without taking into consideration the risks that can pop up at any time.
What led to this flash crash occurring? Do you know?
So back in 2018 and 19, there wasn't as much volume on the exchanges. So what happened is BitMEX, which is purely trading derivatives, okay? So it's like futures. Mm-hmm. They're not trading spot. BitMEX used to take its mark price from another exchange. Now, that other exchange is called Bitstamp. Okay, so Bitstamp was a spot exchange. BitMEX used to take the pricing from that. Someone figured out that if they go and sell, let's say, like $50 million worth of Ethereum on Bitstamp and simultaneously take out a short position on BitMEX, they get to short it all the way down and then buy it basically all the way back up. It was common. It sort of happened a couple of times where people were utilizing that mark price to be able to take advantage of one exchange to then lever up on derivatives on another.
Yeah, I don't trade Ethereum, but I now that you talk about that, I vaguely remember hearing about it. I mean, how far did the price go in Ethereum?
It was about 38% or so in a couple of minutes, in a minute or so.
That's crazy.
Yeah.
So what did you do after that? I mean, I guess you're just sitting there with a liquidated account.
I mean, it was just one of my accounts, but when you put everything into like this one trade that goes on for like, a couple of months, and it was a big trade, and then to see like, your hopes and dreams just like scattered in front of the computer in like a minute or two. Yeah, it sucked. It really sucked.
So this flash crash only occurred on those two exchanges. It wasn't like a market-wide thing?
No, it was just those two exchanges.
Man, okay.
Yeah.
Wow.
So, yeah, this sort of stuff happens in crypto. It's a matter of managing risk. And like we all learn from that, having stop losses on is key. You don't go to bed thinking that any position is safe. Or have a hedge on, or, have puts on, whatever it might be. You sort of have to take those precautions because like nothing is safe.
Yeah.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit. And move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more. All in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Let's speak about Astronaut Capital. So this is a crypto fund which you started. I think it launched 2017. Is that right?
Yeah, that's right.
Okay. So I don't think I've actually spoken to anyone who runs a crypto fund. Everyone I spoke to is more of a proprietary crypto trader. I'm just curious about who invests in a crypto fund? Like, what's the typical profile of the investor that you attract?
Honestly, at the moment, it would be more high net worth and family office. So people that are wanting exposure to crypto, but without the same degree of drawdowns, essentially. They would be the biggest market for it right now. And I mean, like a lot of people say institutions usually come in and just buy, Bitcoin or a spot. But for a hedge fund, it's those that are wanting a unique strategy that are not wanting to manage it themselves on a day-to-day basis, because essentially they don't know what to buy and when to sell. So that's what we do.
They leave that up to you.
Mm.
How come you went down this route of funds management instead of just continuing to trade a personal account?
After we came up with the research company for crypto, which was in like late 2016, early 2017, we had a bunch of people that offered to give us money. And, at first we were like, no, we're just sort of like trading our own cash. In fact, we're writing all of the research for ourselves, but we put it out there anyway. But it sort of came to a point where the demand was pretty strong. So we thought, why not? So we went down that path and we opened our first fund, which was more so like longer term investments, like ICOs and stuff like that. But it was our second fund that we started in 2018 that started attracting a lot more capital, which was more so once again for trading. It was a hedge fund that would trade purely just in liquid tokens. Why did we do that? I guess for us, I mean, having a fund and trading on behalf of other investors, it's got both its like good side and its bad side. Obviously, you're always having to give rationale to investors as to why you make the decisions that you do. And I think the most difficult part about that, actually, particularly in crypto versus more so than any other asset class, is, for example, when you're shorting the whole market or you're net short. And investors in a hedge fund for crypto, they don't necessarily expect you to go net short on the market because they've invested because it's a new asset class and they're inherently bullish. So why are you going short? And if the market goes against you and the market's going up and you come out the next month with like negative NAV, you look really stupid. But and so that's something that you sort of like have to get past. It's not very easy in crypto to be able to do that. And to be honest, we don't do it very often. I guess that's one of the toughest things. Probably one of the best things is sort of the investors that we bring on board are great guys. And they're people that really still do want to understand the ecosystem. Anybody coming into crypto, even at this stage, like I consider anyone coming into crypto professionally or from an investment point of view that's writing a decent sized ticket to be relatively early and quite smart. And so, we've always had a good network of those sorts of people, and, it's good to have them as investors.
Did I hear you correctly in saying that investors who are coming in now are still early into the crypto market?
Yeah, if they're coming in with larger tickets, I'm not talking about retail here, but if you're a family office or you're a high net worth person that's allocating a few percentage of your wealth into the market, that's more than most. It's more than most. I understand completely that retail is out there and everyone owns like, a bit of Bitcoin or Dogecoin or whatever. But if we're talking about people actually putting serious money down on behalf of their family office, on behalf of their investment firm and saying, hey, we need to be in this market for 3% or whatever it might be, that's smart. And there's a lot of them that aren't doing that. I still consider that quite early.
Yeah, okay. Interesting. I think last time we spoke, or when we caught up a couple of weeks ago, you made a comment about how there were quite a few crypto funds which have shut down as of late. Is that right?
I think we saw in 2019 and early 2020, we did see quite a few, particularly around March last year as well. There was a couple of larger ones that also I think were on the wrong side of the market, or I think actually a greater cause would be the amount of leverage that they were employing.
Okay, so that's been in most cases, what's led to their demise is the being over leveraged.
Yeah, which has been pretty common in crypto. As I said, I mean, you don't expect these huge falls like March all the time, but when they do happen, and even if you're levered up, and in crypto, I know this sounds like a lot in traditional markets, but in crypto, it's not for some. Some funds lever up, 30, 40% or something like that. So let's say like 3 or 4 times even. And, if you see a drawdown in the market of 50, 60%, you're out. And yeah, we know of a few funds that happened to early last year.
Are you able to speak to the growth you've experienced over the past 5 years or so?
In terms of AUM?
Yeah, and maybe returns. I don't know if you're able to disclose that.
Yeah, look, I mean, we've seen our AUM, I'll talk to our trading fund. Our AUM started quite small when we launched this second fund in 2018. Throughout 2019, it was also quite low until the end. I guess before this sort of market started going up, which let's call that in mid 2020, we were able to collect about 5 times the AUM that we previously had. Since then, obviously with performance and new subscriptions, that's gone another 5-fold. But I guess talking about returns, since we started this fund, it's roughly up about now probably about 1,700%.
Okay, that sounds pretty crazy.
Since early 2018, yeah. And I mean, I guess for this sort of thing, you also have to look at it on a comparison to Bitcoin. So if you're a fund, the question is, have you outperformed Bitcoin if somebody just bought BTC and held it? In our case, we have, which is great. I think a lot of funds need to also do that as well, as like benchmark themselves, to actually find out whether they're outperforming the broader market or not.
Well, that is one of the things I actually did want to ask you about, because being a crypto investor or a crypto trader, you're dealing with an asset class that goes on these absolutely monster runs. I'm not quite sure the right way to word this question, but I sort of want to ask you, like, how much of your performance is due to alpha and how much of it's just due to being in an asset class, which, as I just said, goes on these huge runs?
So, okay, I think this comes back to our strategy. Okay, so number one, I mean, we're a hedge fund. So when the market does go through a lull period, like it did in 2018 and 19, we cut positions much earlier. So obviously we don't lose as much of that capital going down. For us, it's more of how do we make that capital going up, and that comes down to exactly like where we deploy our assets to. And most of the time, in fact, for us at least, it's not Bitcoin. So, I mean, I guess like a quick brief as to like how our strategy actually works. We focus on, number one, we're trend traders, which is pretty easy. A lot of people do that. But to bolt onto that, we focus on basically thematic asset allocation. So that means that crypto in its entirety is like a meme. Generally, that's how we think about it, right? It is a meme. And within crypto, there are all these different verticals that essentially people will run to every now and then, and they will experience huge pumps, like a lot of alpha in comparison to Bitcoin and the broader market. So that might, when I talk about these verticals, it could be like DeFi, or it could be L1s, it could be DApps, NFTs, like there's a whole list of them. So it's our job to basically identify early on which one of these verticals is about to take off and what's going to outperform Bitcoin and the broader market on like a momentum basis. That is essentially our strategy as to how we achieve, I guess, alpha in comparison to the benchmark.
Can we go into this, as you described it, thematic allocation or rotation a little more? Like, you know, if someone's listening to this and they think maybe that's something I want to bolt on to my way of trading, I mean, how would they start to do something like that?
Sure. Okay, so there's a couple of things. I would say the first thing is identifying like out of the top 200 coins that exist, you know, classifying them as to what they are. Like, are they L1s, or are they currencies, or are they DeFi, whatever? Put them into different baskets. I guess the most granular you can get, the better. Okay. Then what you do is, particularly on if you encounter a day in the market where things are quite neutral or even down, have a look at what is showing strength, like really apparent strength. It might be a few percentage points, whatever it is, but keep an eye on that. And if those days continue to happen, then that should flag something for you. It should say, well, wait a minute, this particular asset here, and let's just say, for example, it is something in DeFi. This particular asset is showing strength and everything else is like neutral or flat, and it's been showing this for like 3 days. What's up? So then have a look at that. What we then do is that we then do a analysis on social sentiment for that particular asset. So we'll go have a look, basically see what the engagement has been like from the community or crypto Twitter or Reddit on this particular coin, and understand why it's getting that strength. From there, I guess we then look to apply, on-chain analytics. So have a look at who have been the buyers of this particular coin, how much money has actually been flowing into it and out of it for like the last week or so. So that will give you an idea of like the capital that's moving around and flowing through it. I guess those three things are like the larger part of it. And then the final confirmation for us is if we then see it break out on a technical basis, like momentum, proper momentum divergence from the rest of the market. And if that happens, it gives us a reason to at least allocate into that particular asset. And if we allocate into that particular asset, the next step for us is to allocate more or look at its peers. So what else have we put in that basket that is comparable to that particular asset? Because they're the next things we need to be looking at. So for us, for example, we did this very recently. We've seen like a huge rally in what they call L1 for cryptocurrency, like layer 1 protocols. And so we identified one a few weeks ago called Luna. And that's exactly what we did. And then that led us to go into Solana, which is another one. So that's the type of process that we look to employ in like thematic rotation, essentially.
Okay, couple things. Can I just pick up on your point about on-chain analytics there? You said you want to look at like what sort of capital is flowing in and out of these coins or tokens. How do you interpret that? Like, what are the sort of things you're looking for there when you're looking at the data?
There's a great platform for crypto traders called Nansen, Nansen. And having a look at that, you'll be able to like basically search a token and you'll be able to see who the top holders are. If they hold them in like their respective wallets that are tagged. You'll also be able to see like the recent large transactions of those. So it will show you essentially like whether, let's say, the top 10 holders of it have added coins recently, which shows that they're accumulating. You can also look at, for example, exchange balances. You can look at team balances and tokens. You can see whether the team is like pumping the market for some reason. So that sort of like program for on-chain analytics allows you to just purely see where this capital is flowing and who it's, more importantly, I think, who it's actually flowing to. Because, if you find out that another large fund is accumulating a particular coin and it's not really public information, then, that essentially is alpha. There's a good chance that they're accumulating that for some reason.
So it's almost like, if we just really simplify this, there's a massive fundamental or kind of a sentiment analysis that you do. And then there's the technical aspect when it comes down to timing the trades. Would that be fair to say?
Yeah, exactly.
So can you go into the technical side of it a little more? Like, do you have an example of the extent of technical analysis that you use?
Yeah, I mean, as I said before, we're more sort of trend traders. Okay, so, but if I had to put it down to, a type, I think we sort of hold a mixture of like a turtle traders / Peter Brandt / Livermore type of thing. It's pretty simple stuff. We're looking for consolidations over a period of time, and we're looking for a breakout out of ranges. That's what gives us confirmation. We look to buy high and sell higher, or the reverse. And look, a lot of people will trade in different ways. That's what we're sort of comfortable with. And to that point, by the way, I think technical analysis works in crypto way better than any other market, like way better than FX or anything. I've done it on all, and many people have also said the same. So we utilize those simple methods because we also know that a lot of people are following the same thing, which basically becomes self-fulfilling in many instances. So a technical confirmation for us would be a breakout of a consolidation, particularly if it's a leading breakout that has occurred with strength that hasn't been seen by other like assets at all. So if we're seeing like much stronger momentum in a breakout of a channel through this particular asset that we've got our eye on, then it gives us even more confirmation.
Are there any other strategies you trade which aren't outright directional, such things as maybe yield farming, or are you involved in anything like that?
Yeah, so there's two other ones that we do. The first one, I guess, it is still semi-directional, but we do a lot of pairs trading. So I guess taken from like the FX playbook, if we are, let's say right now we're in a period of the market where we're like a little bit unsure as to like the stability. There's been a crash recently. The question is, are we going to see a big shock in the system soon? So what we might do is would say, okay, we really like this particular trade here. We think it's going up for whatever reason, whether it's thematic or whether it's something else. We like it directionally. Now we're going to pair it. We need to pair it with another trade that we believe, should we see weakness in the market, is absolutely going to get hammered for whatever reason. So pairs trading for us is basically finding something that's going to essentially continue to diverge. Look for something that is going to outperform substantially. But if we do see a shock in the market, things get like shaky. Essentially, the downside for us from our long position is hedged somewhat due to having a corresponding short in something that is waiting to hopefully just get killed and go down even further. So pairs trading for us is something that we do pretty often. Obviously, you have to match up these pairs, and if you don't, then it goes the other way. Then you're quite screwed. But you have to have the high degree of confidence in that type of trade. And the other thing that we do is more so in neutral markets, which is just covered call writing. So we do quite a bit of options trades, some of it directional as spreads, and some of it just purely just selling volatility to get yield. In cryptocurrency, I mean, if you write covered calls on Bitcoin and you do it, on a weekly or fortnightly basis, you can basically make anywhere between 2 and up to 4% per month on your Bitcoin, which is pretty big. So that's something that we like to do particularly when IV is pretty high.
Okay, again, a couple things I'd like to go into there. The way you described those pairs trade, it almost sounded as though it was more of like a risk management type of, that was kind of your motivations for putting on a pairs trade, is more so than like an arbitrage or seeing a divergence between two coins or tokens, which would often be correlated. Is that fair to say?
Yeah, it can be both instances, to be honest. So we can look at it like, for example, sector specific. So right now, let's say we have quite a bullish view on FTX. They're a great exchange in crypto. So taking a long in FTX, but a short in BNB, which is Binance, is something in which we would be expecting more divergence, okay? Because we're expecting outperformance of one and neutral to maybe slightly bullish in BNB, the other. That is more on, I guess, that divergence side. As a form of risk management, then on the other side, for some trades would quite simply be, yes, buy something that we believe is going to outperform and sell something that is unrelated, even if it has diverged already, but we know is going to get killed. So we do it both ways depending on the situation. And to be honest, we don't know realistically in the long run. I think we've done this quite a lot over the course of the last 2 years. And for us, it's been mixed as to what we would make more money on out of those sort of like two ways of doing it.
And are these pairs trades, are they very, are they kind of quantified trades which you've modeled, or are they more trades which you put on based on your intuition and instinct?
I would say number one, there's a fundamental reason, although we don't consider ourselves fundamental traders. That's why number two, we back it up with basically technical as well. So we look at the momentum of them, we chart them as pairs or as spreads, as you like. From that, we can see that a divergence in plain sight and look for continuation of that trend or of that divergence within the charts from a technical basis.
The other thing you said, which was quite interesting there, writing covered calls on Bitcoin, I'm pretty sure you said, can make 2 to 4% a month. Obviously, people are going to, anyone listening is going to want me to ask you a bit more about that. Like, how would you actually do that?
The best way to do it is, firstly, I think there's one options platform at the moment that is getting most of the volume for options. That's called Deribit. Deribit, just so you know, and as a disclaimer, it's unregulated options, okay? So it's like most of the derivatives that people are trading. They're not by the CME. They're not regulated. So just keep that in mind. But it's where most of the volume is currently, as of today. So a common strategy that people would like to do is they would buy Bitcoin. They would put it into the, let's say 1 Bitcoin. You would put it into your Deribit account. And then you would sell a call option. So that call option could be like, what would say 20% out of the money. So let's just say, for instance, Bitcoin is now trading at 50,000, it's close to. Selling a call option at 20% out of the money would essentially mean that you're selling a call at, let's say $60,000, okay? That's expiring in 2 weeks. Now that might be a little bit further off. We would generally do less, but let's just say that for example. So selling that call option at 60,000 means that If Bitcoin goes up past 60,000, like you collect a premium up front, and that might be like a couple of $100 or like a few $1,000, whatever it might be. And different strikes will have that different premium. So you get that premium no matter what. If Bitcoin goes up and it doesn't hit $60,000 or it doesn't even go anywhere near it, then you've collected that premium and you get to keep it. And the person who bought the call option obviously doesn't earn anything. So they sort of lose out. Now, if, for example, it settles by expiry above that $60,000, then essentially your upside on that covered call is limited. So basically, sorry, I should say your profit is limited. You earn all of the capital gain to $60,000, but anything beyond that 60K, you've lost because you've sold a call over it. So realistically, it's selling covered calls is not it's more of a neutral, maybe slightly bullish strategy if you're riding them very far out, but it's more so neutral to bearish, if you like. It's generally a way for people that will hold their Bitcoin no matter what, but want to receive some income off it, on a constant basis. So it's a good strategy. I would say it's not a great strategy, and that's why we don't employ it for like bull markets. If things are just like really momentum driven, we're seeing the market just like break out bar after bar, there's no point in limiting your gains. If I was writing like calls when Bitcoin was at 5,000 or 10,000, I'd want to shoot myself. But it's those instances where all of a sudden you're exercise and the market just goes up and up, and you've made say $1,000 or $2,000 on each Bitcoin from your premium that you've sold, but you've missed out on $20,000 of capital gain. So that is obviously the risk, and that's why it's a strategy that we look to employ when the market really isn't doing a lot, and it's just sort of neutral or flat.
Yeah, that's great. I appreciate you explaining that. I'd like to pick up a little bit on the risk management side of it. I know we've spoken a little bit about it, but let's go into it a little further. One of the things you said earlier, which was quite interesting, is that the reason which people invest in you is because they want the crypto exposure, but they also want to try and minimize the drawdowns. They don't necessarily know when to the right times to buy and sell, and no one knows exactly, but you do the best you can. How do you attempt to minimize the downside?
Yeah, there's a couple of ways, but I would say the main thing is, as I said, we trade technically. So we always have stop losses on pretty much everything that we have a position on, like actively in the market. But more broadly, we look at the market structure. And I will admit, like even a couple of months ago in May, with the way that the market was and everything that it was telling us, at least just purely from a technical basis, there was a very good chance the market, I think most people trading technically would agree, had more downside to come. It bounced off 30, now it's at 50, but the market was not looking great. For us, we had no exposure in the market the whole time. It was between basically like 30 and 37. And that was a decision that we conveyed to investors. We said, look, we would rather buy back if it is higher at say 38K or 37, 38K, rather than go through this and then see another drop to say 25K or 20K in one night. And it's those decisions, I think, from looking at market structure that you have to make. And they're probably the hardest decisions, but as long as you're open about it, because you can look at previous market cycles. Everyone can go back to the chart and put up their fractals, 2017 and 2018 and 2015 and whatever. And you can go through it as many times as you want, and you can say, oh, it would have been so easy to pick, like, look at this descending triangle and this and that, and, the RSI and whatever. But realistically, looking at it when you're in the moment and you're saying, okay, am I going to take my whole book flat? Because, like, we've got a lot of shit to sell if we are going to do that. So it's very, very difficult. and we make those decisions. And sometimes we're right and sometimes we're wrong. But we are very quick when we realize that we are wrong. We're very quick to go back and get back into our positions and say, okay, we were wrong. We are wrong again. And, we're good to go. And hopefully the market doesn't come back the other way now, but that's just a fact of life. So for risk management point of view, the biggest thing is getting flat, which is hard when you're holding things on all these different exchanges. You've got all these different positions. Like, it's difficult. The other parts is, we use derivatives as well. Sometimes we buy some puts just in case, the market absolutely collapses. But they're the two main things that we look at.
Are there any other things you do, like, just the fact that you are dealing in the crypto market, like this example you gave right at the beginning about this flash crash in Ethereum, like, that's the absolute last thing you want, to become a victim to that while you're managing investors' money. Like, are there protections that you take, and like, I don't even know, like where you store assets? I mean, how you kind of avoid these, it's hard. You can't say you avoid a black swan event, but like other things you do to mitigate the possibility of becoming victim to those things. Like, are there some checks that you need to do before you invest in a new token or something like that?
Yeah, exactly. And that's a hard one, but I'll start off with the exchanges. Like, nobody knows which exchange is, forever going to be solvent, because even the biggest have fallen down at some point or another. Although admittedly the new ones are pretty good. So shout out to FTX as well, that we use quite a bit. They're great. Look, I think picking exchanges is one thing. I think the more exotic that people get within cryptocurrency, and you start getting into these like yield farms and stuff like that, and you've got wallets here and wallets on all these different protocols, it gets very hard to manage. I would say, and this is not just in relation to storage and security, but like, stay focused in the way in which you're dealing with the market. Having assets everywhere and working on all these different strategies, like, you can lose sight of it. And storage of all of these keys as a personal investor is like really difficult as well. I mean, I've lost enough crypto. I'm sure there's a lot of people out there that have as well, just through like purely stupid mistakes. If you really have if you're trading on behalf of investors, then get some custody. Use Fireblocks or Copper. There's a few different sort of like institutional grade infrastructure out there that's really good for this sort of stuff. Outside of that, I would say, like, be wary of the stuff that you're trading, particularly in terms of liquidity, because things may look good on charts, but all of a sudden liquidity can just be pulled like instantly, particularly if you're dealing with small cap sort of stuff. So like, do your research into these coins, because this stuff can it can just get wiped out anytime in like minutes. And that's why, like I say, the most new investors stick to like the top 10 or top 20. You may not be getting like 100x return out of them, but at least it's going to introduce you into the market. And, you're not going to get burned on some, penny coin that's 2 cents or something, and then someone rug pulls it. There's a list of probably 100 things. I think most of them, for the most part, they're about security. So pick a good exchange is the main thing to at least start off with, because then you don't have to really worry about keys. And if you're building up a decent balance, don't keep it on an exchange either. You then need to move it off and on and off and on.
Are there any dead giveaways that you are dealing with, or you've come across a scam coin or token?
I think that there's a couple of signs. I think usually what we've seen, just from like, if we talk about like the management of a new coin that comes in, obviously nowadays you've got a lot of anonymous teams starting, so you don't even know who they are, which for some reason people actually think is cooler, and they get more money now, which I don't know. It used to be, as I said before, we used to see, I guess, a lot more people come in from absolute non-tech related stuff that would come in and raise money, which obviously was just going to get, it was a scam. The money was going to go into their pocket. Those sorts of things. But also when you're looking through investments, coins, have a look at what the team own. Okay, every coin that is out there has a team allocation, and every team allocation is subject to vesting. That vesting can be anywhere from 6 months up to 10 years. If it's on the shorter side of 6 months or 12 months, 18 months, that's where you got to start asking some questions as well, because these are the guys that want to get incentivized rather quickly. As well as, I guess, to add to that, some of these guys have very large foundation reserves. And when you start seeing, you can look at this on chain. If you ever start seeing these reserves that they have, which is meant for like operational costs, if you see them start sending them to an exchange or something like that, that's another sort of sign from an on-chain perspective that could mean they're just liquidating and selling against you into the market if you were buying. So it's hard to identify this sort of stuff. And to be honest, it's difficult because there's so many transactions per day. But if you have the right tools to look into some of these cryptocurrencies, you can uncover pretty much anything.
Are there any tools just off the top of your head that you'd recommend?
I think the one I mentioned before for on-chain analytics is really good. It's called Nansen, Nansen. You'll be able to find it. I think it's the only thing that will come up for that. That's for on-chain analytics. Also, if you're looking for the derivatives, data and options and stuff like that, I highly suggest looking at a platform called Levitas, which is Levitas. It's all free, which will show you, all of the options data relevant to writing and writing covered calls.
Matt, one last question for you. Might put you on the spot a little bit here. Hope not. For any traders, or I don't know if traders is the right word, but for maybe anyone who got drawn in during the most recent bull run in crypto, at the early 2021, who sort of just put some money into it and got interested, got sort of drawn into the market just recently, maybe got burnt as well buying the top, but now kind of sees that, this is something I want to take a little bit seriously. Are there any final words of wisdom you'd leave with them to make their time in crypto a little easier?
Yeah, look, I would say that honestly, I've traded most markets in my career. There is nothing that will give you opportunity like crypto in terms of trading it. The amount of risk versus reward is just unfathomable in comparison to anything else, stocks or Tesla or even meme coins like GME. So take that seriously for a moment. But at the same time, I would suggest that any new entrant, there's this old saying that if you can't sleep at night, your position is too big. And that applies to anything, including crypto. So if you're looking to allocate into crypto, do it. And I strongly recommend you do it. At any price, it doesn't really matter, okay? Buy the high and just wait for it. As long as the exposure that you are putting into the market is something in which you're not going to lose your shirt over, that is what's important. Because you don't want to be loading up your credit card and putting it on crypto, because it is a volatile game. There's a lot of people out there that are really smart, that are trading it as well. And there are some bad actors. There's also a lot of good actors. So just keep that in mind going forward and make sure you're positioned, appropriately for you so that you're not stressing out. And if you do that, I think you're bound to make money at some point in time. Matt,
where should people go to find out more about you? Website, Twitter, etc.
Sure. Our Twitter is astronaut cap, C-A-P. And then you can find us on our website, astronaut.capital.
Okay. And you also publish some research as well. Is that under the same banner or separate?
You will find a lot of it on our same website, on Astronaut Capital.
Okay, awesome. Well, Matt, I've got to say this has been awesome to chat with you. It's been long overdue that I have another crypto trader on the podcast. So, appreciate your time, man. And it would be great to chat again at some point.
Thanks, Aaron. I loved it. Really enjoyed it. Cheers.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
I think this market right now is like the love child of I Am Sam and Gilbert Grape. It's the stupidest fucking market I've ever seen in my life. It literally is. They say the market can be irrational longer than you can be solvent. This is beyond irrational. This is just fucking stupidity. If you just eliminate all the stupid shit from your trading that has no real justification, I'm talking out of the money calls and puts. I'm talking counter trend trading. Every time you short something that is up on the day, every time you go long something that is down on the day because you feel like it's already dropped too much, it's certain to bounce. Every time you did all of that shit, you went against the market. That would probably cover about 70% of your losses, all that stupid shit. And if what you're left with are defensible trades, I took this trade because on the daily chart, it's not extended. It's above all of its SMAs. It's above its technical indicators. It's strong, relatively strong against the market. It's got all these things ticked off, and that becomes the bulk of your trading. Then you'll start seeing a dramatic shift.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Welcome back to Chat with Traders. This is episode 312. It's Ian Cox here, and today's episode is a special follow-up with a guest many of you will remember from episode 255 a few years ago. Back then, I had a chance to sit down with Vincent Bruzzese, known by many as Harry Seldon from the real day trading community. He's been known to be one of the most transparent traders out there, posting his trades live. His returns over the past several years, multiple years north of 60% and even 80%, speak for themselves. Vincent is a former statistics professor, a longtime poker player, and someone who spent years in the Hollywood film industry analyzing audience behavior and forecasting human reactions, all before becoming a full-time trader. This time, though, Tessa is taking the lead on the interview because this conversation comes at a moment when many traders are struggling with discipline, second-guessing their reads, and trying to navigate a market that often seems disconnected from both fundamentals and traditional technical cues. Vincent has a way of stripping away the noise, calling out the psychological traps traders fall into, and offering his perspective on a market that often behaves in ways that feel irrational, even to seasoned professionals. You'll hear his unfiltered take on narrative-driven markets, the mental patterns that wreck traders, the practical edges that still work, and what it really means to treat trading like a business rather than gambling. As always with Vincent, there's honesty, humor, and a lot of insight packed in. So with that, here's Tessa's conversation with Vincent Bruzzese.
Hi, Vincent.
How's it going?
Good. How are you?
Going well. Enjoying this market drop.
You are?
Oh, yeah.
I'm not.
Hey, just a quick note. This conversation was recorded on November 6th. You'll hear Vincent reference what the market was doing that day or around that day.
Yeah. No,
Are you shorting?
I've been shorting Tesla all day, and I've had some SPY puts on, and yeah, I think we're going to test the 50 SMA on SPY here soon enough. So.
Yeah, I'm trading the Qs and I just really messed up today. It's something I haven't done in a long time. I didn't put a stop in, and the one time I don't put my stop in, this is what happens. I don't know why I did that. It's just, I think it's complacency. And I thought, oh, I'm just trading a very, very small position, but still, even though it's small, it really hurts. It's like, it's more like I'm mad at myself, not like, like of the amount lost or anything like that. It's more about just the mental, the emotional energy I spent on like being mad.
I think that the only time I've ever used stops if I'm going to go out for a cigarette. So I generally don't use them.
I know. I remember that in the last interview you did with Ian on the podcast. You use mental stops, and I was just I'm still amazed by that because you would really have to monitor it. You're like glued to the screen, right?
Yeah, I have my 4 monitors here, and then I got some other monitors there, and I have TC2000, I have Option Stalker, I have Thinkorswim, and then I have the one option chat room always going over here. So,
yeah.
But yeah, I generally will monitor them and use mental stops. I mean, depends if I'm scalping. Like today, I was scalping Tesla on and off throughout the day, and had mental stops on that. But if I'm doing a longer term trade, like I went long Apple, I'm not going to have a mental stop. I'm just if it breaks down a major support level, fine. But other than that, I'm holding it.
Well, obviously, you know what you're doing because very few people can do mental stops. I don't trust myself to do it. I'm just not at that level yet, and I feel like I trade options, but I also now trade futures. And the one I was doing was just on futures. But I feel like if you're just trading options, I can see why you don't have stops. And like me, when I trade options, I don't use stops because,
right.
Like, if I have a spread or if I have a long call or something like that, there's like a built-in stop in a way already,
There is. I mean, there's a max loss there, right? But, options can drain you, obviously. They can, you buy an option for, let's say, $5 or a spread for $2.50. And now it's down to $1.90, but it's still close to where you got in. So you're holding it. And then the next time you look, it's got 40 cents left in it. And you think, well, what's the point of closing it now? It's only got 40 cents left in the thing. I think I once put out a thing to people and said, every time you looked and saw that it only had 10 cents, 20 cents, 40 cents, whatever, and keep track of it in a journal. And at the end of the month, just added up the total loss you had because you didn't close those 10-cent options, 40-cent options, and add in the times that those actually came back and rebounded, and look at what your net is at the end of the month. And most of the time people found that, if you just close them, even when they're at 30, 40 cents, took the loss, it adds up.
Yeah.
A little bit of savings, every little bit counts, I guess. But It's I guess we'll talk about in the interview. It's a very different market than the last time we spoke, certainly.
We're already kind of interviewing.
Oh, we are.
It's nothing totally formal the way I do it. But well, I can be a little formal. Vincent, welcome back to Chat with Traders.
Thanks. Glad to be back.
Yeah, it's been about 2.5 to 3 years now since you were last on the show. And I remember in when you were on in early 2023, you said that market was like one of the most difficult markets to trade.
Mm-hmm.
Well, what do you think about this market in 2025, now that we're almost at the end of the year too?
Well, let's take a look. So, I mean, I do remember then 2023, 2024 was a strange market to trade. It was very volatile, a lot of ups and downs with it. I think I did about an 82% return in that year. And by the way, for the listeners to know, all my trades are always posted live. I post the entry and the exit, the position side. You can check it out in time and sales. Any broker has time and sales. So if I say I'm going long 1,000 shares or 20 contracts or whatever, you could just see that I went long or where I exited. So you can look up my stats. But I did around 82, 83% return that year. About similar the next year, 2024. This year, I'm down to around 63%. I'm kind of averaging out to the end of December would be around 63% right now. So a little bit off the last 2 years because it is a very different market. But, to me, one, you have to treat trading like a business, right? And I think that's something a lot of traders, they focus very much on the wins or losses on that day. And a lot of people, look, let's face it, a lot of traders are degenerate gamblers, right? And so what they're looking at is their individual P&L day in and out. What you have to look at is your monthly. You have to look at, this is how much I set out to make every month. And you don't want that to range too much. So if you say, I need to make $10,000 a month, you want that to be within $8,000 to $12,000. You want a standard deviation of $2,000. You want a business plan to go with that. That's what people should be looking at is, am I going to be consistently profitable month after month? Now, in this market right now, here comes the contradiction or the problem to me. And we tell traders you focus on price action. Fundamentals are for long-term investors. Fundamentals are for people that are putting together their portfolio. And if your trading can't beat that return, stop fucking trading, right? Just go be an investor. If you can't beat the average return of the S&P every year, there's no point in spending all the time and energy trading.
What's the average return again for the S&P?
What's that?
What is the average return for the
on
S&P?
average, it's going to be around between 12 and, certainly in the bull markets, 12 and 20%.
So if we can't beat, if you're saying if we as traders cannot beat
right.
then don't even trade.
Right. If you put $10,000 into SPY on January 1st, if you can't beat what your portfolio total is going to be on December 31st of that year, there was no point in doing it, right? Because sure, everyone can just put their money into SPY, or you could just put it in the Mag 7 or any other combination, a couple of risky stocks. Trading is meant to beat that return, and you got to do it consistently. The problem with this year is this is probably the most hated rally in the history of stock market rallies. The market continues to go up with excuses of, they're going to cut rates, or inflation isn't that bad, the economy is doing well. Valuations have gotten so stretched that people no longer believe the rally. So what happens is you become skeptical of these huge moves up in SPY or in the market. And what that results in is you take profit really quick, right? Let's say you're long Apple or Tesla and you're up $1 a share.
Mm-hmm.
You grab that dollar share and you run out because you constantly think, this isn't going to last. This is going to run out. My luck's done. And traders in general do not come from a rich mentality. Rich mentalities are, things are going to work out. Why? Because things always fucking work out for them. Why wouldn't they work out? Things are good today. They're going to be good tomorrow, and they're going to be good a week from now. People who aren't rich, people who aren't born rich, certainly, they're always waiting for the other shoe to drop. Always. Something is going to go wrong in their life. Even when good shit happens, they know some bad shit's right around the corner and everything's going to get screwed up again. So they bring that mentality to trading. The moment you get $1 profit, $2, they run away with the money because they're just so certain it's going to reverse on them.
Mm-hmm.
Now, when this market hits and you're looking at these constant, like it's just nonstop up ever since, the big liberation day, it's been a nonstop ride and nobody believes it. Talk of AI bubble, talk of valuation stretch, talk of the Feds aren't going to cut, makes it very hard to hold on and let those winners run.
Do you believe it?
I think this market right now is like the love child of I Am Sam and Gilbert Grape. It's the stupidest fucking market I've ever seen in my life. It literally is. They say the market can be irrational longer than you can be solvent. This is beyond irrational. This is just fucking stupidity.
Do you think it's temporary, or is this the new normal?
It's temporary. It is absolutely temporary. There's going to be a correction at some point, right? When calling tops is not a very profitable business model, but there will be a correction simply because, put aside rate cuts, put aside all the other tariffs and all the other shit, valuations are just out of control. The stocks are too expensive. And people have to remember, most of the liquidity in the market aren't from me and you and traders. They're from institutions. They're from 401ks. They're from portfolios. And in order for that liquidity to keep up, you need JP Morgan and Goldman Sachs to continue pouring money into the market. They need to be able to look at friggin', what do you call it? NVIDIA. And they need to be able to look at half these stocks and go, that's a good price for me to buy it right now. And it's not, sure, Google might still be a decent deal and maybe Amazon, but by and large, the valuations on these things are disconnected from reality. It doesn't make any sense at all. So no, I don't believe it, but I do believe that a bull market can run and run and run until there is a catalyst, until something causes the bubble to burst. What will that be? It could be, NVIDIA bad earnings, which I doubt would happen. But, it could be anything. It could be an escalation. It could be inflation hitting harder. It could be the Fed saying, no rate cuts. It could be any one of these things that can cause and spark a sell-off.
When you said that the market is irrational, when you say irrational, are you talking more about the structure or like the sentiment or something more psychological?
I'm talking about, markets are always not based on what you see today. It's based on what the market believes a year from now or 2 years from now is going to be the reality. So, they're not buying Amazon for what it's valued today. They're buying it for what they think it can go, forward, Pete, and all that. And that's where you can get these bits of irrationality, right? Where story and narrative become more about are a bigger part of the valuation than the actual fundamentals. That's what happened in the big .com bubble, right? Where it was all narrative. There were companies with almost no revenue, no profit, and it was all about what it could do going forward. I mean, look at PLTR. PLTR is a $500 billion company right now on terms of valuation that has what? $1 billion in revenue. Maybe 500 million in profit. I mean, if you just look at the books, so that's based on clearly not what it is now. It's based on what it will be. Look at Tesla. Tesla couldn't sell a car for its fucking life right now. It's dropping it's dropping everywhere. But people are buying Tesla based on robots. People are buying Tesla based on robo-taxi. They're not
They're
being
optimistic.
Hmm?
They're optimistic.
Yes. And so when that optimism, when narrative becomes too much of the story, that's where you get bubbles, right? Because eventually some of those narratives pop. Some of those narratives aren't reality. And when a big enough narrative pops, it causes a domino effect that, well, if Tesla's narrative wasn't true, then all these others probably certainly aren't, because if, we all believe this one was a sure thing. And when one pops, then they all, and that's where you get that whole cascading effect down. It would take a lot to do that. I don't think that we're going to see a AI bubble popping anytime soon, but I do think a market correction certainly is healthy.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading, Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit, and move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more, all in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
If this market is driven by narratives right now, do we need to be better at the timing?
Relying on price action and not relying on what we feel and what we think will happen. I mean, look, there are a lot of great, even if your people are afraid of playing the market, there are a lot of great passive ways. For example, Pete, you remember Pete Stolzers, who from One Option? And I got to give all the props to One Option. I've been a member there for, what now, 6 years. I don't own the company. I don't work for the company. I've just been a member. I help them run the chat room there. It's one, you spell out oneoption.com. And he's been advocating for just selling puts, selling puts, doing some bullish put spreads on stocks you might want to own and collecting premium, because you got some high premium right now. And so, if you look at something like Tesla, for example, you can go in on Tesla and sell the 400, you can sell the 405 puts for $1 right now that expire tomorrow. Are you okay owning Tesla at 404 if it crashed down? Yeah, probably. It's not a bad price for it, I guess. It would have to drop $40 for you to get assigned. Okay, again, that's probably not going to happen tomorrow. So you could collect $1 in premium off of selling 405 puts that expire tomorrow. That's not a bad way to safely play this market, is to sell puts in stocks that you don't mind owning.
Mm-hmm.
And if you sell a put, the rule is the premium is great, but you cannot be unhappy with being assigned. Mm-hmm. You have to also want to own that stock. There's a little bit of fundamentals with it.
I feel like, I never do that because I'm more of a trader, a day trader or swing trader. Mm-hmm. And I can try that, but I just feel like that becomes more like a longer term. Yeah. Mm-hmm. And it doesn't really appeal to me, but that's something to consider in this high volatility environment.
It's not a bad way to just put some passive income in there. Particularly I recommend in this market right now, if anyone also has their long-term stock portfolio, that they keep. A lot of traders have a separate account. They have an account that they just keep some stocks in, and that's their long-term account. If you're going to add stocks in any type of long-term fashion in this market, I would recommend certainly don't buy the stock outright. Just sell the puts, just sell the premium, and just keep doing it until you get assigned, and then you'll own that stock. It's a much better way than just outright buying the stock right now. So if you're like, oh, I want to add Tesla to my long-term, don't buy Tesla. Just sell the 430 puts for $4.
Yeah, and then if you get it, great.
You get it, you would have bought it anyway, and now you get it at a better price, and you collected the premium. So it's just, not a bad way to do that.
Assuming, the trader has a lot of capital.
Assuming you have a lot of capital.
I mean, and it's not for everyone.
It's funny. My son, who is 20, he's a junior in Berkeley, and this summer, he came home from the summer, I'm in LA, and he wanted to get a part-time job just to have spending money, whatever. And so I suggested to him that he should do trading instead. And he had an account, it's about, I don't know, $5,000-$6,000 in his account. That's, a small account. Every time he got money or whatever, he just put it in, and he bought NVIDIA, and he bought different stocks, and he built up the $5,000-$6,000 college student. And so he traded it over the summer, and I posted every one of his trades in the chat room. He had 13 straight successful trades, and he made around $3,000 off of his $6,000 account. So he made like a 50% return over the summer. So he turned his summer job into spending 1 or 2 hours a day trading. I didn't tell him what to trade. He texted me and said, hey, I'm going to go long Google. Do I see any red flags? But you are, as an example. But he did a 50% return. And to me, it was a great validation of, even with a small account, you can manage to, because $3,000, that's pretty much what he would have gotten making, being a barista at Starbucks over the summer.
What was he, was it options or?
Yeah, options.
Credit spreads, debit spreads?
A couple of debit spreads or straight call, in the money calls or in the money puts. He'd buy 1 or 2 contracts at a time. So if he wanted to go long Apple, he'd buy Delta 0.7, 0.8 call on Delta, maybe 1 or 2 contracts because they're like $800 each. And he had 13 straight winning trades. He used some of the scanners here on Option Stalker, and he used some of the charting on TC2000 and did great. I mean, of course, he woke up at 11 a.m. every damn day, but fine. So
just recently he started trading, you're saying, like as a part-time kind of thing?
Yeah, he never traded before.
I
taught him how to trade leading up to it, but he's never active.
Well, it helps to have you teaching him. He's lucky.
Well, if he lost, I would have disowned his ass. So, change the damn locks.
So he hasn't lost. So that's, every trader at some point will go through that. And so he hasn't gone through that though yet.
No, but he is also a degenerate gambler, and he's on the Berkeley poker team, and he's really good at poker, but he's had some pretty bad gambling losses, I'd say. But no, he hasn't lost trading stocks yet. But you're right, most traders, look, when I started, I think I told you last time, when I started, I lost 6-figure account twice. Got my ass beat. Yeah.
And you crawled back out of that.
Yes, I did. And traders hate to hear that. If you want, look, in this economy right now, it's a very appealing prospect to be a trader because there's not much job security. People are getting laid off. Trading gives you the financial independence and a skill set that allows you to make money, be your own boss, all the things that people want, right? So it's a very attractive idea. What's not attractive is the idea that it takes 2 years minimum to master this shit. And I'm talking 2 years where you're not spending 2 years losing. You're spending 2 years paper trading and trading one share and getting your ass kicked. And if you can imagine any type of job that gives you, this job security, the freedom, all of that trading does, that doesn't require you to put in either years of schooling or years of sitting at a desk, working, grinding your way up through the bureaucracy to get to where you want. Any job takes time, effort, dedication to get what you want out of it. Trading is no different. The problem is that because the rules are so fucking easy, go in, get an account, buy, sell, done. Everyone thinks they can just go in and do it. It's kind of like playing poker or playing chess. It takes a minute to learn, and then you go in and lose, because most of it isn't just about the rules. It's about the mindset. It's about recognizing the patterns, all of that shit. So yeah, it's a great job if only traders would realize they need to actually put in the time to learn it.
Exactly. Given your statistical background, you have can't say statistical background in human behavior model. You model human behavior in the past.
Yes.
Did that impact your trading at all? Did that give you an edge? Did that help you?
It kind of hurt in the beginning because I was an arrogant motherfucker and thought I can do this. I can read the patterns. For me, ever since I was a kid, it was always being about obsessed with predicting human behavior, and the stock market is the ultimate representation for that, which is why I hate when shit is so irrational, because predicting irrationality is irrational. So in the beginning, it was, oh, I should be able to predict this. And I fell into that trap in the beginning that a price action is one thing, but I could rationalize why a stock would go up or down, right? Like, I'm going to go long Netflix right now because I just found out how many people, 1 million people, were laid off. Well, they're home. They don't have money. They can't afford really to go out to the movies or any other entertainment. So they're gonna, Netflix subscriptions are going to go up because of that. As if institutions haven't thought of that shit. As if that's not already priced in. I would sit there when in the beginning thinking I was smarter than all of them. They have hundreds of millions of dollars in their research departments, but no, I knew something that they didn't think of, right? Like they're going to call up, Vinny from LA has an idea. Like they fucking knew that, right? You very rarely will come up with something, a rationalization that they haven't thought of already. That's what the idea of being priced in is. And that's why price action is so important, because all that matters is what are institutions doing. Yes, retail traders have a bigger impact on the market today than they did 5-10 years ago. Mm-hmm. But institutions still move the market, and you want to be on the side of the institution. So when I finally figured out, right, and when I started learning, and when I hooked up with Pete and started seeing what he was doing with real relative strength, and then I founded Real Day Trading on Reddit, because I realized, okay, I got it. I've now been consistently profitable for whatever it was when I started it, over 2 year, 1.5 years straight. And everyone else out there is losing all their money. And all these other subs and all the other YouTube channels, they're all trying to sell people the shit that doesn't work. So I figure, all right, I don't need their money. I want to take money from people who have money, right? Most people who are trading or who are trying to learn how to trade are paying money for a stupid, 3-bar method, how to scalp low floaters. Those are the people that need money the most. I don't want to take their money. I want to take, the rich fucker's money, who has way too much money and is sitting around playing on the market. So that's why I started the sub Real Day Trading, to help maybe teach people, look, you're doing it wrong. This is how you should be doing it. Stop the fucking scalping. Stop the out of the money calls and the out of the money puts. Go buy a fucking scratch off ticket or go to Vegas. You'll have more fun. Don't do that shit. This is how you should trade if you want to consistently make money.
So what really turned your trading around from losing to becoming profitable? Was it more the strategy, or more the mindset, or just the time in the market experience? What really?
I'd say about 90% mindset. I think it was, one, realizing when gambling was gambling. Mm-hmm. Right. And a lot of times it was simply saying it out loud, like, I'm gambling, like not trying to justify a trade that's clearly a gamble. Just admit it. You're gambling here, right? Like this is a gamble. If you just eliminate all the stupid shit from your trading that has no real justification. I'm talking out of the money calls and puts. I'm talking counter trend trading. Every time you short something that is up on the day, every time you go long something that is down on the day because you feel like it's already dropped too much, it's certain to bounce. Every time you did all of that shit, you went against the market. That would probably cover about 70% of your losses. All that stupid shit. And if what you're left with are defensible trades, I took this trade because on the daily chart, it's not extended. It's above all of its SMAs. It's above its technical indicators. It's strong, relatively strong against the market. There's the market. When I say market, I'll think of SPY. SPY is the proxy for the market. It's strong relative to SPY. It's got all these things ticked off. And that becomes the bulk of your trading. Then you'll start seeing a dramatic shift. If you start going into things without confirmation, too many people try to front run shit, going long before it's confirmed because everyone's afraid of missing the move. Yeah, you're going to miss the fucking move. A lot of it. What you're looking for is the scrap. The institution gets the move. Sorry, they do. JP Morgan will get 90% of that move. But guess what? That 10% of the move, you can make a damn good living off of. So if you see something break through the SMA and you're like, oh, now I want to go long, make sure it closes above the SMA. In fact, if you want to be real conservative, make sure it opens above it the next day. Then go long. Did you miss a lot of that move? Sure. But you also miss around 90% of the time you're going to get your ass kicked.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up and welcome, my friends. You are listening to Chat with Traders, episode 222. Today, my guest is Luke Cummings, and I'm sure a few of my day ones will remember Luke from way back when he was a guest on episode 31. But either way, Luke is the CIO of Harvest Lane Asset Management, a Sydney-based hedge fund with a core strategy of trading in mergers and acquisitions, or M&A for short. Now, unlike our first chat in 2015, where we spoke about all sorts, this time I had one very specific objective when asking Luke back: how to properly assess and successfully trade around takeovers. You know, I think it's quite easy to be intimidated by the idea of trading takeovers, as there can be many moving parts. And I know for me, it's certainly a bit of a knowledge gap. But as there are plenty of professional traders out there who have built their entire career solely on takeovers and merger arbitrage, I feel it's worthwhile to at least gain a base understanding of how these deals come together and how to spot potentially profitable opportunities when they exist. Believe me, Luke does a phenomenal job of explaining the entire process, from the point of when a takeover bid is first announced to the market, right through to completion. I learned heaps, and I'm confident you will also. Folks, I'm pleased to present Luke Cummings. I am actively trading, mostly day trading, but obviously I'm seeing all the announcements that hit the market throughout the day and sort of pre-market, etc. And as you're well aware, these announcements come out about takeovers, etc., and these deals happening. I very rarely trade around these events, mostly because I'm pretty clueless about, the ins and outs of how it all works and where there's kind of an opportunity to be had, and if there is an opportunity to be had.
Sure.
So pretty much when I see these kind of announcements, I just ignore them for the most part.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Ditch those rookie trading apps. Get traders choose Tasty Trade. Visit tastytrade.com.
Aaron Fifield.
Hey crew, welcome back. This is episode 224, and as promised, we're rolling on from last time. Here's the best of day trading, part 2. Just to remind you, this is a compilation of snippets from past interviews, all of which are applicable to day trading in some way. From technical intricacies, insights about various strategies, to trading tales and broader viewpoints on day trading, there's a lot jammed in here. In putting together these compilations, besides creating a quality resource for day trading wisdom, it's my hope that I can bring your attention to a few episodes that you may have previously not heard. So listen out for the episode number prior to each clip. Then you can simply type in chatwithtraders.com/episode number to hear the full thing. Now, let's hit the ground running with a couple clips from equities trader at 7 Points Capital, Stan Glusman. The first clip on recycling shares comes from episode 211, and the second from episode 171. The thing I love about this second clip is it's a great example of the edge in understanding the nuances and structure of your market. Essentially, these small things can make a big difference. Just that you spoke about when you are trading intraday, if you're short something, and it drops, you're going to cover into that wash. This is something I think you do really well from seeing, your executions, which you occasionally share. A good example of this was how you traded Tesla, I think predominantly on the short side intraday, and then you flipped to long when there was a, big wash into what happened to be the low of the day. I'm quite interested to know more about how you do this, how you think about, timing these trades intraday, what determines a good price to add, etc. So I know there was just a whole bunch of questions in there, but how do you think about recycling shares on an intraday trade?
It's all about the trend, and it's all about the volume for me. So if the trend is still holding, if the stock drops, bounces, and puts on a lower high, I don't know if it's going to be a higher low or a lower high, but I'll, as it's curling down, I'll re-add back. So one important thing that I started doing, I think, was it 2019 or 2020? I don't remember. I started doing it a while ago. Is, for example, if I'm shorting a stock, if I'm adding or re-adding shares to a short position, I don't short on a green candle. I try not to short on a green candle as much as I can. So I'll only short on a red candle so that I know if the stock bounces, I'm gonna short as it already put on a lower high. So whether it's a 1 minute chart or a 5 minute chart, it's better if it's a 5 minute chart. So a red candle, as preferably even as it's breaking the low of the previous candle. Yeah, so I'll add back on the lower high as long as the trend holds, pretty much. So I'm staying with the trend, lower high, I'm adding lower high, or re-adding, and I'm covering into the washout, lower high, re-adding, covering into the washout. And for me, the main indication of a reversal where I should be going long is a volume exhaustion. So if the stock really extends, and also extension from the mean. So if I'm watching, let's say, VWAP or some sort of a moving average, and the stock really extends from its mean, I know that I should probably be closing or scaling out of my short position completely. So usually I would cover half, but if it's really getting extended on big volume, I'm going to be covering the entire position. And once a massive volume bar comes in, I'll be looking for some upticks. So it's still going to be a red candle. I'll be buying on, but I want to see upticks. I want the stock to start going up, and then I'll start longing it. So only when I see massive volume and extension from the mean is when I'll be looking to buy it. And it's a dangerous setup, and it's not it's for someone who's a little bit more experienced, because if it doesn't stop going down, you can find yourself holding, a long position, and just it's kind of off the cliff against you. So the stop has to be pretty tight, hard stop. Once once I'm in full size. But yeah, like I said, extension from the mean and huge volume is my main indication for reversal.
Okay, so a few things. When you're re-adding, so say you're short, you've covered some into a wash, pops up a little bit, you're looking for another lower high, as you describe it, to re-add short, but you're kind of waiting for it to like curl over a little bit before you do short it, so you're not kind of shorting that front side pop, if you want to call it that. Okay. When you talk about these volume extensions, points where you will look to cover your entire position and possibly flip to a long. Extension from the mean, I mean, how are you determining what is the mean?
The mean, so I'll use a few moving averages. Like I'll use, for example, I think I'm using a 20 SMA on a 5-minute chart. So I'm looking at that one, and as well as VWAP. But for the most part, if the stock just extends, and I've actually coded into my Thinkorswim platform, but I actually don't use the Thinkorswim charts anymore. I used to have this code that shows the percentages in percentages how far it is from the mean, and when it like kind of breaches a certain number, I'll start to think about going long. But now I just like look at it and see if it's like way too far and it's just straight down, like really far from the moving average, then I don't automatically go long. I wait for the volume. I want to see massive volume, and that basically means like people are getting stopped out. Like it's like max pain level where everybody's just getting blown out, and the stock is there's not going to be much more selling after that, after everybody gets blown out. So, and then a little bit of an uptick, and I want to start in and add as it's working.
So, I mean, it's probably fair to say you have a pretty good feel for these sort of things nowadays.
I mean,
which is why you're not so reliant on the things you've coded to look at the actual percentage it is from.
Yeah, because it varies from stock to stock, like percentage wise. But I used to be more systematic, and now I'm a lot more kind of reactive. I don't really think about like what exactly I'm going to do. I was actually telling my girlfriend, I was like, I don't even know what to talk about on this podcast. I just kind of I don't even know what I did today. I just traded today. I have no idea what I did today.
Just on autopilot.
But yeah, so I feel like with experience, the more trades you put on, you kind of start to feel these things. So I don't even know I'm not sure what moving averages I'm even using, but as it's extending from it like really far, there's an opportunity, and that it's just about timing when there is an opportunity.
Yeah. When you are flipping to long at these points, and I'm sure you don't do this every time, but when it seems obvious to you, I mean, is it easy for you to just flip your bias like that? Like I'm sure you've been holding a decent short position throughout a decent chunk, and then all of a sudden you're flipping to long. Is it easy for you to flip your bias like that, or is that something which has also come with more experience?
It's just hard to sit through a pullback when it actually puts on. If you're holding and the volume gets exhausted and it gets extended from the mean and it starts to come back, it's really painful to sit through that low and not cover any. So now I just know that more likely than not, it's probably, if it didn't bottom out on this candle, maybe next candle, pretty rarely it'll, keep dropping. But if I do go long and it bounces just a little bit and starts to curl down again, I'll probably trim or even get out and see if this is kind of an outlier move. But yeah, I wouldn't say it's difficult to flip bias. The only bias is to make money. So if I feel like the stock is going to bounce, then I got to go long.
The only bias is to make money. I like that. When you're talking about routes, you're talking about how you're sending your orders to the exchange, like which exchange you're routing to, right?
Correct.
So can you just go into that a little more? Like, why is that an advantage?
Okay. For example, you're looking at the level 2, the bid and the offer, and there's like 25,000 shares on the offer, and it's printing some shares on the offer. It's printing 1,000 shares, 500 shares. So normally, if I'm just using ARCA, if I want to sell on the offer, I would add liquidity on ARCA and wait until I get filled. And I'm going to be the dead last person to get filled. If I have dark pools, access to dark pools, I can throw 200 shares on 10 different dark pools and see if I get tagged by one of them. So, and chances are I will get tagged by one of them. Chances are it's like Credit Suisse is printing on the offer. So I can just put my entire order on the offer and be the first one to get filled. So I'll skip the line and I can actually get short on the offer and see if the stock drops.
Okay, so it's a way for you to jump the queue.
Yeah, exactly. Yeah, and those are the strategies. When I came in, those are the strategies that I saw Mike execute, and I'm like, I was speechless. I've never seen anything like it. I've seen him execute like 50,000 share orders on the offer, like skipping the line and then getting short and covering at the midpoint. Those strategies, they don't really work anymore, but we still do have access to those dark pools and aggregators, and like I do use them from time to time. Like this morning, I was trading FCX, and I was getting short with Morgan Stanley on the dark pool.
So are you going to, let's say you want to get short, but you don't want to hit the market, you just want to join the offer.
Yeah.
Are you going to send, I think you said before you might send 200 shares to a dark pool to see if it gets hit. Are you going to send that to like 10 different dark pools and see which one gets hit first and then pull your orders on all the others?
Yeah, that's correct. Exactly.
Okay, so as soon as one gets hit, then you're going to reload and with your full size.
Yeah, so that's one way to one way to use that technology is to get short if you actually want to execute a position. And I want to like jump the line and, I'm going to see who's buying and then sell to that buyer. Another way is that if the stock is actually going up and I want to know, is this a real buyer? or is this just going up with the market or like with the ETF, that kind of thing? So I can throw a bunch of orders to different dark pools, different aggregators, see who tags, and keep throwing it there. Is he there? Is he still there? Is he still there? So I can be actually long, but I'll keep selling to him a little bit different, at different prices to see if he's still there. So for as long as he's still there, I want to be long. Once he's not there anymore, I'm actually selling my position and getting short because it's probably going to roll over because he is the only guy who's buying right now and pushing the price up.
Okay. And I'm just thinking about the time it would take to send like 10 different orders to 10 different dark pools. Do you have some technology which assists you with that?
Of course, yeah, one button. I have like 150, probably about 150 hotkeys. So it's one button.
150 hotkeys?
Yeah.
How many keys are on a keyboard?
I'm not sure, but I'm utilizing everything. I have like Control Q is one, but like Alt Q is something else, or Shift Q is something else. So
what's your most used hotkey?
It's probably F2, which is just short the bid.
Okay. What, take the whole bid, or how many does it short?
Oh, it's just whatever quantity that I put in level 2.
Okay, so you got to type that in and then you hit your hotkey.
Yeah. I use a scroll wheel to scroll up and down to pick my size, and I hit F2.
Next up is the one and only Sam Bankman-Fried. This is a slightly longer clip, but incredibly interesting, and it comes from episode 177, recorded in 2019. Since then, Sam, an ex-Jane Street trader who went on to start trading firm Alameda Research and FTX Exchange, has been noted by Forbes as the richest person in crypto with a net worth exceeding $20 billion. You know, the natural question would be, why was it important for you to be active on so many exchanges? Like, what advantage was that to you?
Right. So the basic answer is that there are two ways to think about, what exchange you would choose. One, if you think of yourself as a liquidity taker, is my goal is I want to get long Bitcoins. I just want to buy a bunch of Bitcoins, right? And that's what you're saying. Then, first of all, it doesn't matter that much where you buy them. But to the extent it does, you just have to find the one or two exchanges where you can find the best liquidity, where you can buy everything you need without having much impact, without paying large fees, and that it'll interface nicely with your systems. Another version of it, though, is like, I'm a liquidity provider, and my sort of role in crypto is to be on the other side of those trades, and to take advantage of arbitrage opportunities that arise because of customer demand. And so a lot of how we think about our trading is not like, we're just going to buy a lot of Ripple today. What we're thinking about is like, where do we see imbalances in supply and demand? Where do we see a ton of customers trying to buy some asset and not enough liquidity? So the price is running up there, maybe more than it's running up in other places. So it creates an arbitrage opportunity, but only if you're able to sell where the customers are actually buying, and similarly buy where the customers are selling. And so because of that, as a liquidity provider, it's important for us to be able to be out there wherever there are customers. And, there's a lot of customers in crypto, and they're not very centralized. As you might expect, a pretty decentralized space. And that applies to the jurisdictional and sort of exchange ecosystem as well. And you have, a lot of this is cultural. You have, Chinese users on Chinese exchanges. You have American users on U.S. exchanges, Koreans on Korean exchanges. Some of this is legal or regulatory. Some of this is where people get banking hooked up to their exchanges. And some of this is which products people demand and which exchanges have those. But because of this, you have a lot of isolated pockets of trading on different venues. And we want to be there to provide liquidity on all of those to the customers on each one.
How come you were interested in being a liquidity provider? Because you can trade arbitrage opportunities without necessarily being a liquidity provider. Like, those are kind of two separate things, right?
So I actually think that they're pretty interrelated. And, sometimes people use liquidity provider to refer like very specifically to someone who has a market making agreement, whereas they'll have like a certain number of orders out at all times or something like that. But I think there's a more generalized version of liquidity providing, which just means being there wherever liquidity is demanded, being there to provide to customers wherever customers come. And if you think about what are you doing when you do an arbitrage, you're buying low and selling high. Well, why is it higher in one place than the other? If you're buying on Bitstamp and selling on Coinbase, why is there a higher price on Coinbase than Bitstamp? Well, there are a lot of possible reasons, but actually probably what's going on is some combination of, there are customers who are excited to buy on Coinbase, or there are customers who are excited to sell on Bitstamp. And actually providing liquidity to those customers is often exactly the same thing as doing that arbitrage. Both of those are another way of saying you're selling to the customers bidding up Bitcoins on Coinbase and buying from the customers selling their Bitcoins on Bitstamp. And by providing liquidity to those, two sort of imbalanced supply and demand venues, you are actually completing the arbitrage. And most arbitrage arises because of something like this. Some place where there is an imbalance in liquidity demanded between two different coins or venues or platforms or derivatives or something like that. And you're kind of providing, sell side to the buyers and buy side to the sellers. And probably the buyers are driving up the price, the sellers are driving down the price. And so you probably have done an arbitrage when you did that.
Okay. So I guess when I think of a liquidity provider, like the first thing I think is they've got, bids stacked on one side and offers stacked on the other side, providing liquidity.
Yeah, and we do a fair bit of that as well. But again, I think these things are actually somewhat related. Like, let's say we've got a lot of bids stacked on one side and offers on the other. And now a customer comes in and lifts one of our offers. Well, that offer probably was above what we thought a Bitcoin was worth, which means that probably we can go buy Bitcoin somewhere else at a slightly lower price, or at least that's our hope. And if so, we've just done an arbitrage where one leg of it was the liquidity providing. And so I think that, if you're providing liquidity successfully, you're probably doing arbitrage at the same time. And the flip side of this is, and this is a little bit trippy, but I think it's basically true. People always think about the liquidity provider and the arbitrager as the one who's making, and the customer is the one who's taking. But imagine that, instead of offering a Bitcoin at $13,005, I offer a Bitcoin at $13,006. Then a customer places a bid at $13,005 and I sell to their bid. Is that really that different than if I just had that Bitcoin offered at $13,005 in the first place? Like, it's sort of the same result, but we flipped who's making and who's taking. And now you can get rid of the 13,006 offer if you want, and it's still sort of the same. And what you end up seeing is that, like, there's actually a really thin line between making and taking when it comes to providing liquidity. And, you could have had a lot of offers out for them to lift, for customers to lift, or you could wait for them to place their bids, then hit their bids at the same price your offers would have been at. And sort of both of those are providing liquidity to the customers. And similarly, both of those are, probably you think you can do some sort of arbitrage with them. And so I think that, while it is generally the case that liquidity providers are the maker and customers are the taker, that needn't be true. There are places, and in fact, there are a lot of places in traditional finance where for various marketing reasons that's not true. And the customers are the makers and the liquidity providers are the takers. And it's actually quite similar of a dynamic.
I think what might be interesting is if we could maybe go through, as a liquidity provider, as how you trade, how you would react to maybe certain scenarios.
Yeah, absolutely.
I guess like this video I mentioned earlier where there was a huge sell wall on a particular exchange. I mean, what are you doing in that situation? I know someone can just go watch the video for a much deeper explanation, but, obviously there's large sell walls or buy walls, vice versa. It doesn't really matter. But, when you see something like that, how are you reacting?
Yeah. So, the context here is someone sold about $100 million of Bitcoins on Binance the other day. And they did it by just placing a giant offer for, $100 million. And so, how do we react to something like that? Well, I would say a bunch of things go through our, sort of think about a bunch of things at once. One thing is, who is providing to this customer? And that's sort of the liquidity providing side of this. Someone just tried to sell $100 million and they probably can't just place an offer and immediately get lifted at the current market price. I would not be excited to take on a $100 million position at the current price and then have to figure out how to get out of that. So what's probably happening is they're driving down the price. Whether that's happening because, and there are a lot of ways you can imagine that happening. They just keep lowering their offer until someone lifts it, or they just send one giant offer at a very low price at the beginning. But either way, there's sort of this auction almost where they're auctioning off, 10,000 Bitcoins to whoever's willing to bid the most for them and seeing how low they have to go to get those buyers. And so the first thing that I think about is, well, should we be one of the buyers? Are they offering these Bitcoins at a price where we actually just want to buy them from the customer? And if not, what price do we want to buy them at? At what price are we yeah, we'll just buy those. And in this particular case, actually, they placed their offer low enough eventually that we did definitely want to buy them. And again, you kind of see this relationship between taking and fretting there, where there weren't enough bids out to fill this order. So instead, they just placed it as an offer and waited for the liquidity providers to come in and take their very low offer for the Bitcoins. So the first thing is, do we want to buy this? And once we decide yes, the second thing is, well, can we? And the thing in crypto is that you don't have one balance sheet. You have a separate capital pool on every exchange. I can't spend my dollars on Coinbase to buy a Bitcoin on Binance. That doesn't work. So the next thing we need to do is get a bunch of capital over to Binance to buy this with. And in particular, the seller was selling it for what's called Tether USDT,